Hello, my name is Jacqueline Barco and I'm a Clinical Assistant Professor of Accounting here at Indiana University Northwest. In this video, I'm going to discuss with you financial statements, analysis, and cash flow items for your business plan. Each financial statement tells a different story about the company. In this video, I will explain the income statement, the balance sheet, and then statement of cash flows. Please remember that all of your financial statements are your projections, and the estimates you have used for your projections should have some background. That is, they're simply not made up. For additional information about some of these costs, please review the Record Keeping and Cost Terms video, and for additional information about assumptions, please review the Risks, Assumptions, and Financing video. The income statement is also called your profits and losses or your P&L. This shows all your profits and losses over time, or all of your income minus all of your expenses. Components, as you see here, include revenues, cost of goods sold, gross profit, operating expenses, your operating income or earnings before interest and taxes, other income or expenses, income before taxes, and ultimately your net income. Your plan should include projected income for the first 4 quarters and the first few years. The first 4 quarters will highlight your anticipated profits and losses for the current year. Beyond the first year will demonstrate your plans for growth and increased profits over time. If using the accrual basis of accounting, this will not show your cash inflows and outflows, rather what revenues were earned and what expenses were incurred during the time period. Here is a sample income statement. Please remember that everything included here is a projection, and you should be indicating how you arrived at each assumption. This is vital to demonstrating your understanding of the potential sales for your business. Highlighting your research and understanding of these potential sales and expenses will add credibility to your potential profits over time. The balance sheet, or the statement of financial position, shows the assets, liabilities, and net worth of the company. This should be a snapshot of a company at any given point in time. Assets are the resources of the business, both tangible and intangible, that have monetary value and provide a benefit to the company. You will organize them by current and long term. Current assets will convert to cash or be used within 1 year. Long-term assets are fixed assets that will take more than 1 year to liquidate and provide a benefit beyond 1 year. Examples include cash, accounts receivable, inventory, equipment, and buildings. Liabilities include all of the debts the company must pay. You will organize by current and long term. Current liabilities will be paid 1 year, and long-term liabilities will be paid back over longer than 1 year. Examples include your unpaid bills, any loan repayments, or mortgage payments. The equity shows the net worth of the company. This is your assets minus liabilities. The equity section is organized into different sections. They are investments contributed by owners and retained earnings, or the leftovers each year from your profits. Assets should always equal liabilities plus equity. Remember that all assets are purchased with either debt or equity financing. Please see the Risk, Assumptions, and Financing video for additional information on financing. Here's an example of a projected balance sheet. Notice the statement is on a given day and not for a period of time. This is all projections, so you should be able to justify your estimates as with your projected income statement. You should also demonstrate with your financing section how you plan to both make large asset purchases and make repayments for debts, including interest. There are many different ways you can use your projected financial statements to illustrate how you believe your company will measure up against competition. Analysis means comparing both your company to your company's anticipated performance from period to period, as well as against industry standards. As already mentioned, be sure your financial statement items can be justified to show your analysis has merit. See the Risks, Assumptions, and Financing Options video for additional information on assumptions. Remember, analysis calculations cannot stand alone. Different industries will have different standards and acceptable amounts. Keep in mind that your income statement shows your income over a period of time. You will want to demonstrate your ability to increase sales over time, as well as show that an investment will result in a return. This will help with those who invest. You will also want to show the times interest earned to show to any lenders that your projected capability to meet interest payments. Common income statement analysis ratios include common size analysis, which shows each item on the income statement as a percentage of sales. Your return on sales is your profit margin. And your return on investment compares your net business profits to your startup investments expressed as a percent. And your times interest earned is important for demonstrating you earn enough to cover your interest payments. Remember that the balance sheet shows the financial position at any given time. The balance sheet is organized by current and long-term items where applicable. Your projections should show your abilities to use assets to make payments as they come due, as well as demonstrate your financial structure by comparing your debt and equity. Current ratio compares all current assets to all current liabilities. A greater than 1 indicates enough current assets to pay current liabilities as they come due. The quick ratio includes only cash, accounts receivable, and marketable securities instead of all current assets and compares them to current liabilities. Your working capital is your current assets minus current liabilities. Your debt ratios compare your debt and equity. Your debt to equity, which is debt divided by equity, and then your debt ratio compares how much of your assets is purchased with debt. Here is a sample table showing some analysis calculations. Remember that you do not want to show some ratios as standalone and should be sure to include any industry standards. This is going to demonstrate your ability to compete in the industry. Your business plan should include projected cash flows. Investors and lenders will want to see that there is a potential to generate positive cash flows. Your projected cash flows should show enough cash inflows to cover cash outflows, as well as demonstrate ability to meet future cash needs. Here are some strategies you may consider including in your business plan to illustrate your cash flow strategies. While you may not be able to follow all of them, your business plan should indicate your understanding that cash flows must be carefully managed to ensure that you have enough cash flows when needed, while avoiding keeping too much cash on hand. Cash flow is defined as cash on hand plus cash receipts less any cash disbursements. Cash flow categories include operations, investments, and financing. Each tells a little bit of a different piece about your company's cash flows. Remember that a positive cash flow is excellent, but having positive cash flows from operations demonstrates your business's capability of meeting future cash needs. Cash flows from operations relate to cash in and out from running the business. Investments include cash in and out for investments such as equipment, vehicles, and real estate purchases. And financing cash flows relate to debt or additional ownership contributions for financing the business. Here you see a sample template for putting together your projected cash flows. Remember that your business plan will show your cash flows that you are projecting, and you want to be sure that your assumptions and estimates are justified to show that your expected cash flows are achievable. In summary, financial statements are a key piece of the business plan. You'll want to be sure that projected financial statements include clearly thought out and well-documented amounts. The next video will explain the risks, assumptions, and financing options you are referencing throughout the projected financial statements. Thank you.